Welcome to the Long-Term Investor. This week, my guest is Eduardo Repetto. Eduardo is the founder and chief investment officer of Avantis Investors, where he is responsible for overseeing research, design, and implementation of the firm's investment strategies. Eduardo, thank you so much for sharing some of your very valuable time with me today.
Oh, thank you, Peter. It's always a pleasure.
And I've had the benefit of working with you for quite a while now in some of your career prior to Avantis. Maybe just to give our listeners a little of your path there, you could give them a quick summary of your background and how you ended up starting Avantis.
But I know you since my hair wasn't so white, quite a long time. As you can see, I have an accent. It's from the south, but way south, from South America. I was born in Argentina, and then I came to the United States to do a master's degree that I did at Brown, and then I got a PhD from Caltech, and then I started working at DFA. I worked at DFA for like 18 years. So a little bit short of 18 years. I became a co-CEO. I was CIO also. And in 2017, I resigned and kind of retired. Did a little bit of nothing for a couple of years. And so, you always have the urge to do something. I don't play golf, so the days become very, very long. I play squash, you cannot play 5 hours squash. I don't know who can. I can't. And so the guys from a company called American Century, that is a big asset management company based in Missouri, just same state as you are, reach out and say we want to start something new, and if I was willing to help. And yeah, why not? It was a good idea. I think they have the right infrastructure, the right company, and they want to start something new. And so we say, if the fees are low, and we wanted to have low fees, and you know that we came to market, Peter, with very, very low fees, and if we can do it in a way that I don't have to move because I live in Los Angeles, we're happy to work together. I know these people for more than 20 years. And so in 2019, end of 2019, September, we launched ETF, and then we launched mutual funds, and here we are. 2 years and a little bit short of 3 years, we have 12 billion and growing. Now we have around 16 ETF in the market, soon to be 18 to more. We have 8 mutual funds, and we have SMAs, and we're happy to have happy clients.
Well, for listeners who don't have context, that's extraordinarily great growth for the first 2-3 years of a fund. So, Eduardo, congratulations on what you have built thus far, and it'll be exciting to continue to watch the evolution. And today, I'm sort of hoping you can help our listeners learn a little bit more about some of the philosophies that are underlying your strategies. I know in my role, we are very passionate about what a lot of people refer to as factor investing. And so I am thinking of some of the things that we could talk about today, thought that this would be a really great place to start, and maybe even starting at the simplest level. Could you just define for us what a factor is in your mind?
Yeah, happy. So first, I accept your congratulations about the growth, but you say what you have achieved, and I want to correct a little bit. It's not me. We have an amazing group of people. No one in its own can do what we are doing, and so we have an amazing group of people with a lot of experience, and they deserve the credit. To be fair, and you know some of them, and you know how good they are. So let's go back to factors. And so what is a factor? So we always think about securities, stocks moving in different directions, one going up in price, one going down in price. But in reality, there are some group of stocks, depending how you group them, that tend to move together more than others. So you can think about securities that have certain characteristics tend to move together. And so when you are thinking about diversification, for example, you say, I'm going to have a lot of stocks. And that's good. That's good for diversification. Unless all these stocks that you buy have similar characteristics and they move together. So you think that you are diversified, but you have different eggs at all in the same basket. They move together. And so what is a factor? Basically, a factor is something that is used in finance in order to identify securities that they move together. We call it commovement that they have. And so there are certain securities, small caps, for example, tend to move among themselves more together than when you think about the comparison of a small cap versus a large cap company. Or companies that have very low price relative to fundamentals tend to move together more than if you compare them with companies that have high price relative to fundamentals. So a factor basically is a way to identify what securities have these properties that they move together. And there are many, many different factors because you can imagine that there are certain characteristics that group securities in a way that move together. I told you small caps versus large caps, or low price securities versus high price securities. And so there are many of these factors that help you identify movement of securities, things that make those securities move together. There are some factors that are more important than others, as you can imagine, because when you're trying to form portfolios that have higher expected returns, those factors are associated with higher expected returns. So difference in returns among securities. There are other factors that just measure movement, and those are important for diversification purposes, not so much to increase expected return of the portfolio.
And so you mentioned the fact that different securities have different expected returns, and the underlying reason being that they're all a little bit different. They have different characteristics, but why are some characteristics or factors, and can I use those words interchangeably? If not, please tell me so. But why are there higher expected returns, or what a lot of people refer to as premiums, for owning certain types of characteristics within a portfolio?
Yeah, that's a great question. So first, let's try to think about a world where every security has the same expected return. So you buy the whole market, you have expected return, and each one of the securities of the market have the same expected returns. Do we think that that world is feasible, is real? The answer is probably not. There is no reason to have every security have the same expected returns. Some securities will have higher expected returns. Some securities have lower expected returns. And if the price of the security change, the expected return of the security also will change. So the expected returns of securities there is no reason to have all the same, all of them have the same expected returns. And expected returns of securities is not a constant of the security. It's not, this is your expected return and it's with you forever. No, it's a dynamic process. Expected returns change. And how they change? Because the price of the security change and the fundamentals of the security change, the earnings, the liabilities, think about all that. So when the fundamentals of the security change, the price also changes, and depending on that relationship between fundamentals and price, how much one changes versus the other, the expected return of the security will go up and down. And think in a very simple way. Think that you have a stream of cash flows, a company making earnings over time. The more that you pay for your earnings, the higher the price of the security, the lower your expected returns, because you are paying more money for those cash flows in the future. The lower the price, the higher expected returns, because you're paying a lower price for those cash flows in the future. So, as Peter, as you said, how can I identify what securities have higher and lower expected returns? Because that's fundamental if you want to create a portfolio that performs better than just buying the S&P 500 of the market. Yeah. Well, what matters? We already spoke a little bit about what matters. Fundamentals. How much money the company makes. No, the balance sheet, because a company may make a lot of money, but being full of liabilities. Or the company may make a lot of money, in earnings, future earnings, but and also have a solid balance sheet, a good equity position. So fundamentals matter. What else matters? Price. Because if you pay too much for something, returns are low. If you pay a low price for something, returns probably are higher. And I always think about the restaurant. Peter, let's suppose that I tell you I have this restaurant that has is an immense experience, great food, great service. Yeah, is that good for you? Well, it depends on the price. If I tell you the price is exorbitantly high, yeah, you enjoy the food, but the truth is that, oh, at the time of paying, you suffer. If I tell you, no, it has a low price and the food is great, I say, oh man, can I go away? Well, this is the same. Price matters. And not only price relative to the fundamental, the earnings of the company, the balance sheet of the company. That is what matters.
And when you talk about low price for buying some sort of fundamental, whether that's cash flow or earnings or the book value of a company, if you pay less, you can expect to earn more. And I think for those who've listened to the show a lot, now you suddenly start to hear how we're talking about what a lot of people think of as value. And you're looking for good value. A common factor I know that comes up in academic circles and within industry conversation is the value premium, the value factor in general. My question to you, I suppose, is that there's a lot of ways to be a value investor. So how do you think about it? Because it has perhaps evolved over time for a number of people.
Yeah, yes, and that's reasonable. Look, science evolves, knowledge evolves, data availability evolves, and so we have to evolve. You like it or not, and we have been evolving. Everyone has evolved. You have been evolving, and so it's good to embrace this evolution of knowledge. And so, yeah. So how do I think about value investing? As you say, is buying good value. So paying low enough price relative to whatever you are thinking about, that seems to be a good deal. And if it's a good deal, it means that you have high expected returns, higher than the market expected returns. A reason why not to buy the market, but to buy something else. This is such a good value to me that I'm buying this instead of buying the market, or mixing it instead of just buying the market. So if you go back to the restaurant, so why price matters? Because I can tell you, 3-star Michelin restaurant, super amazing one, and I tell you this has a low price. So okay, that's good. I can tell you a restaurant that has not 3 stars. Let's say they have only a mention or just half a star. I don't even know if that exists. And I tell you, at the same price than the previous restaurant, yeah, a 3-star restaurant at this price and a no star restaurant or half a star restaurant at the same price, what's its value for you, Peter? And probably you say, it's the same price. The other one has amazing food, amazing service. I go to the 3-star one. Okay, that's value for you. If I tell you the same, I say, no, now I'm telling you, a half a star restaurant is 1/10 of the price of the other one. They say, oh, maybe I don't have such a good food, but it's still good enough for the price that I'm paying. So that's value for you. So value is what you get relative to what you pay. So, okay, when you were speaking about companies, what are we buying when we're buying a company? We are buying the company's future earnings, and we are buying the balance sheet, the equity of the company. So if you think about that, you know, I want to pay as little as possible for those future earnings and that balance sheet. You know, that's why you buy a company. So what we think is, hey, I want to buy a company that has good profits, yeah, good profitability, good balance sheet at a low price. And depending on the relative value, the relative comparison between the price that you pay and these other two fundamental variables, some companies are more attractive than others from the expected return point of view. Same as the two restaurants that we spoke. If you tell me a company has low earnings, but the price is extremely, extremely low, that may be a better deal than a company that has high earnings and the price is a little bit higher. So that relative comparison between the company fundamentals and the price is what allows you to say, well, these companies seem to have higher expected returns than these other companies. These companies that have higher expected returns are a value buy. They're a good deal to buy, and they're expected to deliver more than the rest of the market. And so our value strategy is focused on those companies.
Now, a lot of people listening, if they've ever traded in individual stocks, that might all sound familiar to them to say, yes, when I was buying individual stocks, I was trying to find the ones that were cheap relative to their earnings or their cash flow or their book value. But the research indicates that it's better off to buy all of the relatively cheap companies as opposed to picking whichever one you think is correct. Can you give me a little insight into the empirical research on that? And at what point in time you have enough exposure to a number of different stocks to achieve that diversification benefit and still benefit from getting a higher expected return from buying low priced stocks relative to their fundamentals?
That's a great question. So why do I need more than one stock if I can buy one that is the cheapest one? And the answer is simple. We know information as in the most simple way. We know information as of today. Yeah, that company is well run, has good earnings, the price is super low. Everything sounds great. Yeah, but tomorrow there may be new news. The CEO takes off. The company has a new competitor coming into the market with better technology. So there is a lot of uncertainty around all this. The moment that you have uncertainty, it's not a sure bet anymore. If you have uncertainty, you want to diversify that uncertainty risks. And so why? Because I may have a company that has very similar characteristics, also low price, so also high expected return company, and I'm more diversified. I have less uncertainty if I have both of them, because it's all that both of them will have the same bad news coming, probably one or the other, or probably none of them. But the more that you have of these companies around, the more that you diversify that uncertainty about, for example, future possible bad news. And so it's not that you are sacrificing expected returns, because you are finding a group of companies that have low price relative to these fundamentals. So you're not sacrificing expected returns, but you are minimizing your risk. You're minimizing this uncertainty about, for example, future outcomes that are not known today. And so it's kind of a free lunch diversification if you think about that. It's a saying, why to take so much risk and be in love with that particular name, that particular stock, if I can have similar expected returns, minimizing that particular idiosyncratic that we call company specific risk. So you're just better off. It's just common sense. If you go back a long time, like 80 and 90 years, these concepts were not completely understood. People were thinking about expected returns and not completely thinking about the trade-off between expected returns and diversification risk management. That's understood today. There are things that we don't know that hopefully we will get to know more and more in the future. But that's understood very well today. There is a trade-off. You want to be diversified. And many people say diversification is like a free lunch. You are not giving up much, but you are really, really getting benefits from that being diversified.
Well, in sort of on a tangent line there, so it's important to diversify across securities, but there's also the opportunity to diversify across factors. So, for example, we've been talking a lot about cheap relative to a fundamental, but something like cash flow, it's one thing to go buy all of the relatively low priced companies. Perhaps it's even better to go buy all of the relatively low priced companies who have good cash flow as well. Could you kind of go into some of that thinking?
That's expected return issue. Now we are not speaking so much about diversification. We're speaking about cash flows. And let's go through this. Let's go back to our restaurants, and then we go to stocks. Let's suppose that you have this amazing restaurant that has amazing food. Yeah?
Yep.
And the price is 10, whatever 10 is, $10. And then you have this also amazing restaurant. By the way, it has amazing food, but the drinks are really, really bad.
Well, I don't
Yeah.
like that.
You have this other restaurant that has amazing drinks, also at $10, but the food is just horrible. So, and then you have a third restaurant that has great food and great drinks, also at $10. Which one do you think that is a better value for you? The one that has great food but drinks, the one that has great drinks bad food, or the one that has both things good at the same price? Well, I say, if you're going to eat, you need to drink something, at least water, you know? If you're going to eat, the food has to be good, no matter how good the drinks are, because if not, go to the bar. And so these first two ones may be a good deal because the price is good, but it's not really an amazing deal. If you have one that has both things good at the same price, that's even better. So let's go and speak about companies. Let's suppose that I give you a company that has a good balance sheet. Yeah, happens to have a good balance sheet. Yeah, but earnings are really, really, really bad. Then I give you another company that has great earnings, but the balance sheet is just horrible, full of liabilities. And I give you a company that has good balance sheet and good earnings. All of them are the same price. What do you think that is the best value? And at the end of the day, you say, well, good balance sheet, good cash flows, same price, seems better than the other two. Same. This is what you see in the data. If you look at the expected return of companies, you want companies and everything related to price. You want companies that have these two characteristics together. You're looking at these two characteristics together: good cash flows and reasonable balance sheet, also trading at a low price. Those securities have very high expected returns when you compare it with the rest of the securities. And so if you're thinking about what's value and premiums for you, well, those are the kind of companies you want to have in excess of market weight if you want to have higher expected returns. So this is what our value strategies are. So we try to focus on those companies. If you think about technically, we say companies with high discount rates. So the market, for whatever reason, is pricing them at a low price. So think about that. If I tell you this company has great earnings, yeah, what do you think that the price will be? You say, in general, we say high. And say, look at Yahoo Finance or look at Bloomberg or whatever you Schwab account or Fidelity account or TD account or whatever you look, the price is low. You say, oh, that seems to be a good deal, but that's exactly what we're telling you. It seems to be a company that has high expected returns. The price happens to be low despite the fundamentals being strong.
And as it states on your website, I'm going to read this right now. We believe market prices represent an unbiased view of a company's prospects and risks, and that paying lower prices for our share of future cash flows should produce higher expected returns. It's almost like that summarizes perfectly what you've been talking about. There is a hint, although not exactly, but a hint of efficient market hypothesis in there. Is that correct?
Oh, there is a lot. There is a lot about that. So it's telling you I'm biased. And basically, what we're saying is think about something that is a fair game. Yeah. What does it mean a fair game? That you cannot really predict the future. No. So basically, that's what the efficient market is saying. Hey, you can say, oh man, this company is going to jump in price tomorrow. You really cannot predict the price change. You can think about long-term higher expected returns because the price is low relative fundamentals, but it's not a sure bet. Like that's why you have to have a diversified portfolio. And you know, some people feel they have overconfidence or they think they have more knowledge that they have and they bet a lot of money in few stocks. Uh, we are not of that view. We are really not of that view. We prefer to recognize the limitations. We know that we cannot predict the future. We know that we don't have a crystal ball that is telling us tomorrow's news are going to be this. No one knows, but you only know. And so yeah, we recognize the limitations and form portfolios that are well diversified.
You know, one of the mistakes that I used to make earlier in my career, as it pertains to efficient market hypothesis was that the case for indexing was efficient markets, whereas in reality, I think the original case for indexing is that in aggregate, everybody's trading with each other, so they earn the market return minus cost. And so index gives you the cheapest cost. Whereas some of the things we're talking about with factor investing, yeah, and I see you making a face, so I'd love for your nuanced correction of that. That would be wonderful. But with the factor investing, it does sort of take more advantage of the fact that price incorporates within reason anything that we could know, and that even if it is mispriced, it's impossible to systematically identify that in advance and profit from it. One thing to identify an inefficiency, a totally different thing to profit from it. But you seemed, from the face you made, to maybe want to tweak how I made the case for indexing and EMH. So maybe go ahead and correct me. I'd love to hear that.
Indexing, unless if you buy the market index, and even with the market index, the problem is there, but it's smaller. It's much, much smaller. In indexing, you are selecting some securities related to others. Yeah. If you buy the market portfolio, you're really not, because you're buying every security in the market, and you are weighting them according to the market prices at the Sheldon Standard. So according to the overall value that the market places to the security. So you buy all the market. That's not much of a problem. The moment that you deviate from the market portfolio, you are making an active decision to be different, even if you are an index fund. So if you say, I'm going to buy a small cap index or a value index or a growth index, someone defined that index. Someone defined the rules for that index. And in general, those rules are very rigid. That's why I call an index. And the general rules have a lot of limitations. For example, we were speaking about the price of the restaurant being low relative to the 3 stars, great food and great drinks that they have. So let's suppose that that's true today. Yeah, we are going to go to that restaurant today. It has great price, great food, and everything. That's a good decision. Let's also decide today that we are going to go there for the full year. Every Friday for the next year, we're going to go to that restaurant. You say, that's a great idea. There is a caveat. Disregarding what's the price. And the restaurant can change the price. You think that's a good deal? Today at that price, a restaurant is a good deal. If 10 weeks from now, the restaurant decides to multiply that price by 10, you will question, should I continue going to that restaurant? Probably the answer is, not anymore. Well, that's a problem when you have an index that is a value index or a small cap index or a small value index. They tend to make decisions once a year or twice a year. So, for example, if you are speaking about Russell indices, very famous family of indices, they make their investment decision, what securities they will hold in their index in June, at the end of June. And they hold those securities for the whole year, disregarding how the price changes of those securities. And then next June, they say, oh, the price changed too much. This is not a low price security. This is not the good deal that I thought that it was 12 months ago. At some point during the year, that changed, the price changed dramatically, and it's not such an attractive security. Let's sell it. And when they sell, at the end of next June. So that has two problems. You are holding a security for a period of time, thinking that that was a great deal, when it was a great deal 12 months ago. It stopped being a great deal sometime in between. You say, why you hold it? Because it's in the index. Okay, that's telling you the index is not making the right decision. Even they may have made the right decision 12 months ago, some point in between it stops being the right decision. But the index does nothing about that. The other problem is when they decide, oh, this is not what I should hold. I need to dump it to the market. And I say dump it on purpose because I need to trade and get it done no matter what, because I need the new securities that are in the index. So that has a lot of cost. So the index has two big problems. Is they tend to hold securities they shouldn't because they don't look at the price. You live in St. Louis, yeah? What's the weather
Yes.
today there today?
Oh, I think it's 98 or 99.
So imagine Peter deciding what he's going to wear for the whole year based on the weather today. That's a very bad idea because in January, I know how it's St. Louis. It's freezing. So this is what the index is doing. It makes no sense. And then in the next year, when they have the next change in the securities, say, let's dump all these things and buy all these new things. And that costs a lot of money. So indexes have two big problems, unless if you speak about the market index. So if someone buys a market index, there are reasons not to, but we can speak, but they're more technical, smaller issues. If you buy asset class indices, you're probably making the wrong decision.
And I love that you brought that up and made that clear distinction, especially because the empirical research supporting the emphasis or overweighting of certain portfolio characteristics has been around for quite some time. The products for people like myself to actually access those, they've been around, but there has been a limited number of people providing them. Whereas today, there are more options for people to target cheap companies systematically. And if you buy an index fund, sure, it might say value on it, but you are going to be subject to some of these limitations that you mentioned. The one question I have sort of related to that is, let's say someone were on the fence between owning a total market index portfolio, single fund, we'll assume, owns the whole world of the market weighting, versus tilting their portfolio towards some of these factors like we've been talking about, like value. What would you tell them if they were on the fence between those two options?
But look, if someone wants to hold the market portfolio, I cannot say a lot of bad things about that. I think that is not probably the best portfolio, and we can go technically why.
Sure.
But I have less problems with that than someone buying asset classes, like value, small cap, or index fund. That I have, and they're leaving money on the table and big time, and they're not having the right implementation of the process. If someone buys a value portfolio, market portfolio, I can say, hey, you probably can do better off. You can have similar levels of risk, but have higher expected returns. And that probably would say. And you can explain why they may have not the most efficient portfolio by buying the market portfolio. Because think about that. Peter, many people that come to you and say, hey, I hold these securities. What do you think of my portfolio? And you say, oh my God, how can you have this portfolio this under diversified, concentrated, tilted toward things that you shouldn't be tilted, single industry? So you have a lot of people that buy weird portfolios. Yeah. Okay. What is the market? The market is the average of every investor.
Yep.
So the people that buy weird portfolios and the others. Yeah. So if the people buy weird portfolios, the others have good portfolios. And the market is the average of both sides. And so what's the properties of a better than market portfolio? A better than market portfolio will be a portfolio that is well diversified, similar risk profile, at a slightly higher returns. So that's what we're saying. Well, the market is not bad, probably it's pretty good, but you can do a little bit better by deviating from the market. Without increasing dramatically the risk, you can achieve higher expected returns.
We've been using the word expected returns quite a bit here. And something that comes up when I'm speaking to investors is that if we always see that past performance is not an indicator of future returns. But a lot of the case around factor investing is based on past performance through empirical research. Why would that empirical research be able to inform us about the future, in your opinion?
Yeah, I love your question. My background is a little bit theoretical. Yeah, I know that St. Louis has an amazing zoo. Yeah, and if you go to the zoo and show your kids
Yeah.
an animal with the stripes and say, "Look, animal with the stripes is a zebra," then they go back home and they will think every animal with the stripes is a zebra. That's empirical
Yeah.
research. Do you think that that's true? Can they go and hug the tiger next day? Probably not a good idea. So empirical research, one of the issues that you have with empirical research is that it may be something that happens in isolation in the past, once in a lifetime. Even that once in a lifetime may be for many, many years. but there is no reason for that to continue in the future. So in order to have a reason for something to continue in the future, you have to have a little bit of theoretical framework that says, well, there is a reason why this should continue in the future. And the reason cannot be just waving our hands and saying, it's because of behavioral bias that we have in our brain, or it's because risks that I don't even know how to explain. And well, it has to be a reason. So that's why I love the way that we frame the problem. Everything goes back to valuations. Remember, we were speaking about valuations, price relative to fundamentals. Yeah. If the company is trading at a low price relative to fundamentals, the company probably is priced with a big discount rate. So imagine that you're going to buy an advisor that is next door to you. And that advisor has a building and has clients or produces cash flows and profits. You know that the lower price that you pay, you are discounting those cash flows by a higher discount rate. And the higher expected return that you have from making that purchase of that advisory business. The higher price that you pay, the lower that you're discounting those cash flows, the lower that you plan, the investment will be less attractive investment for you. So if you think about what we have been speaking, it has a valuation framework. We're trying to buy companies that have low price relative to fundamentals. So theoretically, that's fine. You can even put formulas around that. Now you go and say, let's see if the empirical data corroborates our expectations from just valuation, from theory. And then you say, empirically tells me that what I was thinking is okay. It's corroborating what I was expecting from a theoretical framework. So theoretically, it's forward-looking and backward-looking and saying, this is what you should expect. No matter if you're trading Dunkin's in Babylonia 3,000 years ago, or you're today trading security, this is what you should expect. Low price relative to this fundamental should give you higher expected returns. Then you go and corroborate that by looking at security prices. You say, it works. And then you look not only US securities, you look at international securities, or large cap or small cap. And you look at all these different things and say, that works. So now you have empirical data from many different variety of markets, and you have a theoretical framework tell you why it should work. Then you feel very, very good. It's not just empirical data, and it's not just a theoretical model in isolation, because we can develop a crazy model in isolation that doesn't fit the data at all, and it's as bad as just having the data that has no reason to continue in the future. I always say things in the past that don't exist anymore. Think about a company just creating payphones, the one that you put the coin. That's something in the past. It's not in the future. There is a lot of things that happen in the past that don't happen in the future, that empirically you say, look, I observed it for 80 years. Yeah, you observed it for 80 years, but why it will continue for the next 80? So that's why you need this theoretical framework to support the empirical data.
That's a wonderful explanation of it. And oftentimes when people are nervous that I'm speaking to, not just about these strategies, but anything in the market, they tell me, well, the world has changed, but the world is always changing. It's always different. And there are some milestones that seemed unbelievably unthinkable 10 years ago or 20 years ago that we are at today. And so I think really, if you're an investor listening to this and trying to understand that theoretical framework, that can help you give patience when things don't appear to be working. Now, definitionally, I think for the people I work with, they would define not working as underperforming some sort of benchmark. Whether the benchmark is the right one or not, we don't need to go into that detail. But I do think that this approach to investing does require an enormous amount of patience. And all investing does naturally, but
all investment does.
Yes, all investment, patience is paramount. But are there any other sort of expectations that you feel like investors who have a portfolio tilted towards these low price relative to fundamental stocks should keep in mind?
No matter what you do, you say, you are underperforming the benchmark. So, okay, let's look at something more simple. You know that there are many different families of benchmarks. You have benchmarks, indexes created by Russell, Frank Russell Company. You have indices created by MSCI. You have indices created by S&P. Remember, the S&P 500. And others, by the way, S&P 600. There are tons of indices. You have indices created by Wilshire. You have indices created by FTSE. There are a lot of these families of indices. Do you know that if you look at a value index created by one family versus another family, if you look at over a long term period of time, all of them have more or less the same expected return. Not much different. There are some caveats, but not much different. But if you look at shorter periods of time, there is big underperformance of one versus the other. So when you say a manager underperforms a benchmark, I'm telling you a benchmark underperforms a benchmark. And so, what this is the concept is we are dealing with a lot of noise. No, over a short period of time, you have a humongous amount of noise. And so if you cannot really deal with that noise, you have to think about how you're going to invest, because investing is dealing with a lot of uncertainty and noise and focuses on the long term. I told you all these benchmarks over a short period of time underperform each other by sometimes quite a lot. But if you look at the long term performance, all of it is more or less the same numbers. And so if you focus on the long term, you are just better off that is just focused on the short term and the performance. Try to understand why this process, the investment process, should work. Try to understand how tax efficient it is, because the more taxes you pay, the less money in your pocket. Try to understand how much the expenses are, because the more that you pay for expenses, the less that you get in your pocket. And try to think that you have the right risk profile in your asset allocation. Because some of us can take more risk and feel comfortable, some of us will take less and to feel comfortable. And so try to understand all these things and then just go for it. And focus on the long term. Focus on the long term goal. It's like when you start in first grade, thinking at some point you're going to finish your PhD. You're going to have a lot of B's, you're going to have some C's, you're going to have bad days in exams, you're going to have great days in exam. But that's the goal. It's a long journey to achieve that. And, they will have amazing days, horrible days, but overall, it's going to be a good journey. And that's what you have to think about that. And there will be market downturns. When you invest in the market, no matter if you invest in value, no matter if you pick in the S&P 500, you are going to have downturns. If you have a nice chart, and you, Peter, have, and you can share, that shows all the market downturns of 5, 10, and 20% in history. And it's full of downturns in history, so 5, 10, and 20%, full of them. And if you're going, and despite all of them, market has delivered over in the past, great, great growth for investors. So you have to deal with these downturns, because each time that there is a downturn, I'm saying, "Oh, I cannot take this anymore. I'm out." You are conditioning your growth probably not to be as good as if you just say, "It's part of the deal." I always think about downturns as traffic lights. When I drive, I hate traffic light because it seems that I always get the red one. Never two greens in a row. I hate them. Well, that doesn't prevent me from driving. I live in LA. If I don't drive, basically I cannot go anywhere. And so, yeah, you learn how to deal with that. You learn how to be patient, deal with uncertainty, deal with anxiety, and just focus on long term. Hey, man, I'm going to visit my friends. I'm going to drive these 10 miles. It's going to be a lot of traffic lights, but it's going to be pleasant to be there. So I drive. Same is investing in the market despite the underperformance of the downturns.
Well, it's a great transition into what is typically my last question for all of my guests, although I may frame it a little differently because you might have just answered what I would ask with what you just said. And I have to also note that financial theory has a pretty good history of working itself out in the long term. So I often ask guests, Eduardo, what does it mean to you to be a long-term investor? And I think you've sort of shared some of those thoughts, but I am curious, you have, with your background, with your engineering background, with your technical science background, you've had to make deductions or deduce from theory what is, relevant and what is not. So to you, if I'm going to assume that financial theory tends to play out well in the long run, what does the long run mean? What does that mean to you when you're looking at research?
To be fair, it's even one day, depending what's your attitude. So that's true. Think about a casino. A casino has an expectation that is going to win in every ball. But when you go to play in the casino, they are not asking you to be there at least for 10 hours. They say, well, just play whatever you have to play and then go away and someone will come. So when you invest in the market, you have positive expected returns, but you have a lot of uncertainty, a lot of swings. So if you think about the expected return of the market to be around 10% a year, how much is that per day? Well, per day is around 0.04% per day. That's a very, very small number. So if you're investing for a day, thinking, oh man, I'm going to invest for a day, for what? For such a small asset growth, you're wasting your time because the noise, the volatility, the ups and downs of the market are way more than that expected number. So why are you going to take those risks of things going up and down like crazy just for that small number? So you have to think about, hey, if I'm investing in something that moves a lot, I need to have enough expectation that the growth of that money for a long period of time is big enough relative to the noise that I'm going to be making. If not, I just don't know. And so even though technically you can say it's not about time, it's about it's expectation that you should be winning relative to the noise. Why to take the risk if you don't think that you're going to be there for a long time, so that the signal, the expected outcome, is high enough relative to the noise? So think about long terms. Now, if you invest in fixed income, it's different. The volatility, the movement is small, the payout is small, but the movement is much, much smaller. So maybe fixed income is for you if you are staying for a short term. And so I always think that it's a long time. Think about, don't think about, oh, I invested now for the next year, even though technically that's absolutely fine. But the noise related to the expectations of growth or the signal is too small. The noise too big related to the signal or expectation of growth. So think about long terms. Think about saving for retirement or thinking from retirement to death or for the wedding of your daughter or your son, or think about long periods of time.
Eduardo, this has been a fantastic conversation. I'm so appreciative of you joining me here today. I'm going to make sure to put a link to Avantis Investors in the show notes, as well as your full bio. And for anybody who's watching us on YouTube, I'd appreciate if you like and subscribe and leave us a comment. Those impact who we have on the show. And Eduardo, again, thank you so much.
And if you find a restaurant at a 3-star Michelin for $10 with great food and great drinks, let me know.
I know you have a favorite sushi place, so if it falls in that category,
it's
then
good
I
price,
will
great quality,
get it on speed dial.
Great low price, great quality, and that's why I like it. So, okay, Peter, thank you.